Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
This is Steve Meizinger, your host, and today I'll be presenting IFC FX Options Primer. If you're interested in learning more about options, please go to optionseducation.org. You can always call them if you have any questions at 1-888-OPTIONS. Anything I talk about today should not be construed as advice, and you should always consider taxes, margin, and commissions. Options are available on many assets, so whether it's ETFs, equities, equity index, or currencies. Today we're going to be talking about currencies. So what's been happening? Well, we know what's happening in Europe, Greece. Now people are worried about Spain and Portugal. Ireland's been through a tough run. So that's something that you might want to keep your eyes on and know that these currency options are available for you to trade, whether you're bullish or bearish on the U.S. dollar, or even if you're not certain on either direction, but you think it's going to be volatile, well, there's trades that you can implement. And when you're trading, you need to think about risk appetite versus risk aversion. Very important to think in those terms that it's risk appetite versus risk aversion. So we all want to earn tremendous rates of return, but when we're thinking about that, we should also think about, what if I lose some of my money? In fact, the old carry trade of a couple of years ago where you bought the highest yielding currencies and then shorted the lower yielders worked for a while, and then it became a disaster. Not sure when that'll become a disaster again. Obviously, the higher yielders, such as the Australian dollar, has done very, very well. The Brazilian real, but we'll see how long that lasts. Money always has a price. It's measured by the currency rate, so the exchange rate, if you will, and interest rates. So that's what we're doing. We're trading. We're trading money, and it's that exchange value and the interest rate that sort of makes everything fair. Currency exposure is important. So if you're looking to have international investments, no matter where you live in the world, and at some point you're probably going to repatriate the money back to your native country, well, you need to consider that currency does matter, especially if your currency is very, very weak at the time that you would like to bring that capital back. Or actually, if you're in a place where, I should say the opposite, that's actually a good situation, but if you're in a place, let's say, with a strong currency and you have investments in a weak currency, if you needed to take your capital back, well, you wouldn't get a very strong exchange rate. So you'd actually have a couple risks. You have the risk of the investment going bad, whether it's an equity or a bond, what have you, and you also have currency risk. So that's another thing you might want to consider. Due to globalization, investors are no longer just considering domestic, as I said, equities and bonds, but also you need to think about the effects of currencies on your portfolios. So I wrote an article about a year or so ago, and really what I was trying to, is in the Journal of Indexes, and my point being is that currencies matter. So obviously if you're a U.S. investor, and you have all of your capital here in the U.S., you don't necessarily care about what happens with the dollar. You might have some ability to travel, or actually it might hurt your ability to travel, but a lot of us, most of us have some international exposure, especially since many people, many analysts, everyone is going to have their own view, but many analysts believe that over the next couple of decades, places like Brazil, India, China, and it actually outperform some of the, I guess, more of the countries that have had growth for many, many years. So, whether it's Europe or the United States, even Canada, although Canada's sort of in between there, as you have oil that sort of plays in the mix there. But if you look at this slide, what you're seeing is you get a nominal rate of return and then an adjusted rate of return. So really what's happening is that you can go through and basically calculate what your rate of return would be adjusted to the U.S. dollar. And so therefore, if you took a look at, let's say, an investment last August in the UK, the nominal rate might have been whatever it is. Well, in 2008, we had tremendous declines, 31% down, but down 49% adjusted to the U.S. dollar because the dollar is rallying. Last year, we sort of saw the opposite. We saw the nominal rate was up, not that much, but considering that the U.S. dollar was weak, you actually had sort of a tailwind there helping you. So you need to think about it. Currencies do matter. They might help you and they might hurt you, but just so you know, these ISCFX options are available. So if you thought you might want to repatriate some money at some point, there are calls or puts out there. There are spreads that you can put on. There are volatility positions. So lots of different things you can do. You can calculate the effect of currencies on rates, and that's what I did basically in that table. Basically what it is saying, okay, what's the investment doing, and then what's the currency's exposure to it. That's assuming that wherever you're invested, that you're going to want to take that capital back to your home country. If you have some money invested somewhere and you never plan on taking it out of the country, well, currency is not as big a factor there. And also you need to think about your maturity on these investments. So, if you're looking at a 10-year investment, 5-year investment, and you're certain you're going to be there for that period of time, you might not be as concerned with the currency. But if you are concerned about repatriating the money, options are going to give you the ability to hedge. And of course, options can give you the ability to implement a forecast, whether you're bullish or bearish on the dollar. So a simpler way to express currency exposure is the nominal investment returns less currency returns equals real investment returns, assuming that an investor might want to repatriate the money back to the local region. Currencies do matter.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.